Welcome back to Money, Money, Money. Like every new year, we start 2016 with a lot of promise and a lot of hope. So how best can we actually navigate the financial challenges of the year that lie ahead? Well, answering that for us is one of the best financial minds, Nilesh Shah, MD of Kotak Mutual Fund. And we also have with us Lata Venkatesh, who's been doing her bit of quizzing for Nilesh. But now it's time for me to quiz you a little bit more. 2015 was considered to be the year of fixed income. Will 2016 be more of the same, Lata?
Well, as one stands at the start of the year, it does look like a difficult year for fixed income. Let's throw our minds back to what it was in the January of 2015. Rate cuts had not begun. And everyone was actually cursing RBI for not giving that rate cut in December of 2014, which finally came mid credit policy on, I think, January 15th or so. And thereafter, we've had 5 cuts, and almost everyone was predicting that many cuts. 4 or 5 cuts were very much seen. As well, you were looking at an economy that was getting balanced, inflation falling, current account deficit, no problem. Fiscal deficit, the government was repeatedly promising prudence. When a government promises fiscal prudence, it means fewer bonds will come to the market. They will borrow less, which means the bonds that are existing have a chance of prices rising. So it looked like a great year for fixed income. And well, to be fair, in terms of steady returns, it did not do too badly, but it didn't give spectacular returns. Now when we stand, all those gains are behind us. Further macro gains don't seem likely. Now, if this is exactly the thought process that the FIIs have, then some may even sell out, which will mean perhaps more losses. But compared to the beginning of 2015, 2016 certainly doesn't look like a year of fixed income. But the guru of fixed income is our guest.
Yeah, and I want to actually ask you this, Nilesh. It's considered safe, right? Debt, how wrong can you go? But debt funds and their practices also came under fire in the year gone by. So what are the lessons therefore for investors that one should have picked up from, say, like an Amtech kind of an episode?
So they should trust debt fund managers. If you compare vis-a-vis my banking counterparts, the amount of NPA which we have created on the size of assets which we are managing, they'll give their arms and leg for it. So yes, we have made an error, but as an industry, our transparency level, no one has to go to Supreme Court of India to ask where have we invested. We give it on platter to people. And how many mishaps have occurred in mutual fund history over last 20 years? Compared to a small PSU banks NPS, our total industry is far, far lower than them. So don't distrust your debt fund managers. They are doing a great job. Obviously, when times become challenging, we have to work hard. And that is why my recommendation is that, as Lata mentioned, the expected rate of decline in market yields is probably far lower in 2016 vis-a-vis 2015. Hence, the return will come from coupon income rather than capital appreciation, and which is where credit accrual funds provide great opportunity.
What about something like tax-free bonds? The last time you were on our show, you had recommended tax-free bonds, even if one were to buy it in the secondary market. It's unlikely now that 40,000 crores, all of it will come before the end of the financial year. Would it get rolled over? Should people wait for them, buy it in the secondary market? How should it be treated? Given the way interest rates have panned out.
Last year, we were expecting equity markets to be a little bit, docile compared to fixed income market, and hence I recommended tax-free bonds. But now it's the reverse way. You probably can trade in tax-free bond, buy in the IPO under the retail category and then sell it off and invest that money into equity on a systematic basis. On a hypothetical basis, on a notional basis, if I believe that after 15 years that company will be there to repay my bond, I might as well buy some equity of that company.
Okay. Coming back to gold then, you said that, perhaps the bottom is here in terms of prices, but upside may be limited too. In that case, how are you looking at the new gold schemes that the government announced late last year? A lot of the financial advisors have been saying that, they're not half bad. But what's your sense of?
So my sense is that these schemes are actually giving us an opportunity to pay for the sins committed by our fathers and our forefathers. As a nation, we have deployed about $220 billion in import of gold, diamond and silver in last 10 years. That is more than total FDI we received of $170 billion approximately, or total FII flows of $190 billion. If this $221 billion had stayed in this country, we would have ended up creating a bigger India, better India. So we must utilize all our investments in gold only through gold deposit scheme, so that we don't pay dollar for buying of that commodity. We already own the largest amount of gold in the world. We have more than what we need. If we open Padmanabha Swami temple, there will be far more than what we need. So let's use gold bond scheme, and it's economical for you. You get the same capital appreciation of gold. You don't incur the cost of storing of gold, and on top of it, you get 2.75% interest. You can't be better than this.
Yeah. Okay.
No, my only worry is that the gold returns are computed after paying an import duty of 10%. What if in the next few years, by the time the fund matures, that import duty goes? Then at the end you're getting a redemption which could be lower than your invested value.
But when you buy physical gold, you pay import duty, and when you are going to
instead
sell,
of physical gold, I take your point.
Yeah.
But as an investment return compared to a liquid fund and all other funds, are we likely to lose because of this tax structure?
From an investment point of view, it just doesn't make sense to invest in gold.
Okay.
You are paying import duty, you are paying premium for buying gold in smaller denomination, and you are taking huge liquidity risk. Today, banks cannot buy gold back. So your only source of liquidity is jewelers. The jewelers always promises you to provide liquidity, but he doesn't put capital for it. His own stock is financed from banks borrowing. And then he's telling me that you come back to me after 10 years, I will pay you money. I mean, how can I take that at face value? So there's no liquidity in this stock. And remember, if we all Indians put together come to sell gold, who will buy from us?
Yeah, well, that's fair enough. Actually, let's take another quick break on that note while we digest everything Nilesh has told us. When we return, Nilesh and Lata are actually going to reveal their financial resolutions for 2016 and tell you how to stick to yours. Stay tuned. We'll be right back.